If I combine with the existing mutual fund schemes and along with the SIF, everybody can look at, then actually a great risk enhancement strategy. See, I always talk about the looking for risk-adjusted return is a far superior strategy rather than just chasing alpha. If you really look at the perceived perception of FIs is that it's a high risky product. In fact, it's not true. Actually, SIF bring down your risk because the moment you have option to hedge or to short, effectively you're bringing down the beta of the portfolio or deviation or any risk metrics. So it's a great combination if you can play, depending on your risk appetite, you can play 70-30 or 60-40, depending how you want to play. SIF can actually underperform in the trended bull market, but in the flat market or the market which is falling, you can generate alpha and protect your downside better.
We are at a defining moment in India's capital markets. Volatility is back, macro uncertainty is real, and investors are searching for strategies that do more than just ride the wave. They want to ride the tide. Enter SIFs, or specialized investment funds as we call them, a brand new investment category launched under SEBI's framework. SIFs offer asset managers the freedom to run more sophisticated, flexible strategies across equity, debt, and hybrids. Think long-short models, dynamic asset allocation, concentrated bets, derivatives, and capital protection all under one regulated umbrella. And leading the charge is Quant, the first fund house to receive SEBI's license to launch SIFs across categories. Joining us today is someone who has never shied away from thinking ahead of the market. Mr. Sandeep Tandon, Chief Investment Officer and founder of Quant Mutual Fund. In this episode, we'll deep dive into why SIFs are just not another product, but potentially a structural shift in how evolved investors approach risk, timing, and returns. Welcome, Sandeep, to this special episode on SIFs. And congratulations for receiving the license from SEBI to launch the SIF schemes as the time goes by. What made you believe in SIF so much that you guys were the first one to make an application to SEBI? So why are you so excited about?
So first of all, thanks DJ for calling us. So as DJ, you know, our previous avatar of Quant, okay, we used to run one of the largest prop house in the country. Right from 2008 till 2018, we ran the prop strategy. We were like what we call is the facilitation desk. And we used to run different sort of strategies. 380 trader used to work for us. We used to do a average $1 billion turnover on daily basis. So obviously we have this experience. We enjoyed that journey. And this is the reason we were very excited, you know, when we realized that SEBI is looking for this sort of license. We were the first to put an application also, and luckily we got the approval also first. So we are looking forward to launch this product because we think it's a very unique product. If I combine with the existing mutual fund schemes and along with the SIF, everybody can look at, then actually a great risk enhancement strategy. Okay, and you not only looking for purely from a returns perspective, actually you have to see. I always talk about the looking for risk-adjusted return is a far superior strategy rather than just chasing alpha.
So SIFs in that way is like coming home to you.
Up to a certain extent, yes.
In terms of these strategies, have you planned what type of strategies are you guys going to launch?
So as you know, our entire focus is actually equity house. We have filed for 5 ISID, what we call it, like a mutual fund scheme we call SID. Here we call it ISID. We have filed for all 5 ISIDs. 3 from the equity side and 2 from the hybrid. Debt we'll see at much later stage because we don't specialize in debt. So we'll just focus on equity and the hybrid space.
The last 5 years have seen phenomenal growth for you as a fund house and Quant as a fund house. Do you think that SIFs will also bring that kind of a growth in the next 5 to 10 years for Quant?
I personally feel so. Let's say example, you know, I'll give you a small interesting example. Let's understand why AIF, long short centric AIF failed in India. Okay, one of the key reason I say a lot of people who were running the show, they came from traditional long background. Their bias was for a long strategy. Okay, so when you run a mutual fund, what we run as a mutual fund, we run based on the low frequency data, quarterly number, yearly numbers, half yearly numbers. Okay, so entire focus is on the long term and which is deriving from the low frequency data. Where SIF, we think the real strategy will be working on a high frequency analytic, because you can capitalize on the short term opportunities. See, if I have to look at from a longer term perspective, yes, you can go long, and if you remain invested for 10 years, you can make extraordinary money. But when shorting opportunity comes, you make phenomenal alpha in the shortest span of time. Some stock takes, let's say, 3 years to rally 80%, 100%. But sometimes, whatever reason, something is not right. Within 15 days, stock correct 10%, 20%, even 50 to 60%. So it's all about, can you capitalize these shorting opportunity, not only from hedging perspective, but also generating alpha from it. And that's the reason we are giving a lot of weightage in building our high frequency analytic, which used to manage in the past, and then same tools which will be optimizing in the SIF also.
How will you differentiate the return profile between a traditional mutual funds which have got multiple strategies and defined as a underlying strategy versus SIF? How will you place, or how should we also as a distributor place the return expectation of one strategy or one mutual fund schemes vis-a-vis the SIFs?
Let me just explain, if you really look at the perceived perception of our FIs, is that it's a high risky product. It's meant for only for high risk appetite investor. In fact, it's not true. Okay. Actually, SIF bring down your risk. Okay. Because the moment you have option to hedge or to short, effectively you're bringing down the beta of the portfolio or deviation or any risk adjust or risk metrics, if I have to say.
Reducing the drawdown.
Yes. Which means your probability of generating superior risk-adjusted return is always going to be high as compared to traditional mutual fund. So our advice is that instead of saying that, first we have to accept this is a new product and it brings certain unique features, okay, from a risk perspective. So ideal combination, if you can have 50% exposure in in the mutual fund and 50% the SI, then not only you're capturing the upside which can come from the traditional long accounts, but you can also have some amount of alpha can be generated in the downside or protect, okay, when markets are falling. So it's a great combination if you can play, depending on your risk appetite. You can play 70-30 or 60-40, depending how you want to play. But if you ask me as a money manager, what is the recommendation? I will say go for 50-50. It will actually enhance or generate superior risk adjusted opportunity, what you were missing earlier.
In SIFs, there are various strategies, equity, debt, hybrids, and SEBI has allowed certain parameters which goes or relaxed certain parameters which otherwise was applicable in traditional mutual funds. As a fund house, do you see that there was a need for such a strategy to play more concentrated, maybe because now you will not have 10% maximum allocation, you can have 15% maximum allocation, and we have seen within Quant also at times you have hit the, in some of the stocks you have also hit the higher slab which is available in within the traditional mutual funds. Do you genuinely see that there will be more concentrated strategies which will be launched within the SIF bracket?
See, first of all, we have to look at these as a two unique products. Based on your requirement, you can subscribe. Okay, if somebody says I'm a very long-term investor, I'm not worried about short-term volatility, I'm going to typically putting money through SIF route, then I think the mutual fund is a great product. If somebody has that 5-10 year horizon, extraordinary alpha will be generated over a period of time. But in volatile time, okay, so like I always say, the peak of the cycle, risk appetite is highest. Everybody is long-term investor. But which may or may not be true when we have seen, let's say in last 1 year, when market has corrected or consolidated, people have given up. Lot many people have got capitulated virtually at the bottom of the cycle in the month of March, April this year itself. So what is very important to understand, if you have high risk appetite, okay, then obviously small cap, mid cap makes sense from longer term perspective. But if you really don't have that sort of risk appetite, these are great products because your alpha, so basically SIF can actually underperform in the trended bull market, but in the flat market or the market which is falling, you can generate alpha and protect your downside better. Because see, let's understand the difference between the traditional mutual fund and the SIF. In traditional mutual fund, SEBI allows us to hedge. Either you can do true hedging with the help of your single stock futures, or you can do hedging with the indices, okay, whether you talk about options or future. So it's a, you don't get perfect hedge of the entire portfolio. Yes, partly you can hedge, but there is no way you can generate alpha by shorting.
when the markets are down?
Yes, but in the SIF, you do get that opportunity. Let's say in the month of January 2025 was extremely negative on the tech, and I said openly that technology stock can correct 15 to 20%, particularly Nasdaq. It corrected also.
You have a view, but you can't play it in mutual
Yes.
funds.
So the best advantage for the derivative product, you can be optimized when you have a view, and if your view is right, then you can really generate alpha. So a lot of people misunderstand the derivative, like a lot of people saying just a hedging instrument. No, if your view is, if you're able to capture your view or capitalize your view, then these products are great tools. Okay, it can not only protect your downside, actually generate alpha also when the market is correcting or falling. So I think it's the way we define it, everybody has to assess their risk appetite. They have to also analyze their investment horizon. If your investment horizon is not that 5-10 years perspective, and investment horizon is 1 year, 6 months, then SIF type investment can be a better product than the mutual fund.
So you are envisaging that the shorts or the hedges, I would not say hedge, but the shorts, because it is of high frequency and more short-term oriented, more agility, probably one can also start to look at a shorter investment horizon for a category of funds from the mutual fund house as a basket.
So if I have to say, if you look at, if you take as a combination of traditional mutual fund schemes along with the SIFs, okay, there are strategies, what we call it, then what exactly you are achieving? You are achieving a diversification from risk perspective, then you're also diversifying a duration also, okay. So everybody has, I always say, long term, short term, and medium term needs. You can capture these needs, like traditional mutual fund are long term only, okay. But if you have your medium term and short term requirements and you can participate in these products, then the combination is very unique. You will get both the diversification, duration diversification, as well as the risk diversification. So I will say the combination can actually give you superior returns with less pain.
Do you see that there is a lot of talent within the industry? And because so far, as you mentioned, that the long short oriented AIFs couldn't become a larger AUM product in India, and in a similar fashion, if shorting is allowed to a certain extent, because in AIF one can go up to 200% of the overall exposure, but in this case you can only short up to a maximum of 25% and you cannot go short beyond that. Where will you find the talent?
So I agree with you. Initially, it's a struggle. Okay, house like Quant, obviously we have benefit because we have done that. But I always believe when anything new product is launched is over a period of time, by default people will learn, and the next generation, I always say, they are the smarter ones, and they will capture this space. So this is, I think, the traditional fund manager will not able to operate this space, but the young generation, I am very optimistic about generation, they have unique ability to manage these things, and they're, and it matches with this thesis of SIF from the time duration perspective, because they don't have patience. They're looking for very short term opportunity, medium term opportunity. So I think the young generation will do a better job than the traditional ones. So that's the reason, as a house, we have a philosophy. We typically hire 70% very less than 35 years of age. They are more apt for this strategy because your reflexes are more sharper, what is required for this business. Okay, experience is important, so you can have 30% team member which have more experience, like people like me, but you need young talent also who has huge agility and adaptability to adapt based on the prevailing environment.
And when it is about shorting, is it, can you also short commodities, not just equities? For example, within the equity oriented SIF, can you also go ahead and short commodities?
No, it is only in the hybrid fund you can do it, and the equity side is not. Like in traditional hybrid equity fund, you have option of precious metal, okay? And in one or two schemes also, you can do commodities also, particularly multi-asset. But I think the way we have understood the SIF guidelines is only valid for commodities, only valid for the hybrid side.
Where do you see SIFs over the next 5 to 10 years as a ballpark, if equity assets are X percentage or overall mutual fund AUM is X percentage, because in SIF one can launch equity, hybrid and debt all. What percentage do you see over the next 5, 7, 10 years?
So if I have to say for 8-10 years perspective, I think it can be easily between 30 to 50% of the active money management. I'm not talking about the passive part. If I look at the pure active management, that is a potential. Maybe 50% of the active money management can be from SIF also.
And since SIF has just started, will just start to be implemented, I'm sure that there are going to be lot more changes which are going to take place. Anything, any suggestion from your side where it would have been captured better, or the new developments which may be taking place as we speak? People, there are committees which suggest changes to SEBI in this format also. Do you see that some of these developments etc will continue to happen over time?
See, for even for regulator, this is a new product. Okay, even from a mutual fund perspective, it's a
And for
very
the investors
yeah.
also,
For
the most.
everybody, it's a new product. I think it will evolve. That's the way I defined it. If you recollect, in mutual fund in last 25 years, it has evolved a lot. Okay, even the circular has been amended a lot, and it become even the flexibility from a risk perspective, disclosure perspective, transparency perspective improved a lot. The one change which I see, let's say if you recollect the derivative side, when the initial hedging was not allowed, again the mutual fund also started with 20%, 50%, and now technically you can hedge 100% of your portfolio. So what I see, the 25% limit with starting point, the shorting is only 25%.
And then,
I think in next 5 years, if everything goes right, I'm optimistic this number will go to 50%. Okay, I'm not expecting it happening immediately, but maybe 5 years perspective, if product delivers superior risk-adjusted return and experience from the investor perspective is good, I think the regulator will consider that. And I think it's the right approach. Instead of starting at like how AIF, you have a leverage aspect, you can have 2 times exposure. Okay, where exposure out here is only 100%. And a very interesting thing, I tell you, a lot of people have not noticed. What SEBI is talking about is the gross exposure at any given time will not exceed 100%. Okay, which makes this product actually much the risk level comes down. Let's say example, if I'm running this portfolio 100% long, and if I, whatever reason, if I have decided to take take this option of 25% short in the market, then I have to bring down my gross long exposure to 75% and then 25% short. Effectively means my net exposure has actually come down to 50%. Okay, so this is a very interesting thing, that the day you excise these 25%, it means you are bearish on the market or you expect market to fall. By default, you will be forced to cut down your long exposure. So that way, it's a good risk mitigation tool. Okay, if you're shorting, then you are actually forced to cut down your long exposure. So I think this is the inherent good feature which I think a lot of people have not understood, because by default, which is not the case in the AIF.
in general, we have been wired or anchored, I would say, to be only seen from the long story of India, or maybe as an AMC. How do you guys think that you guys will promote that yes, there is a sideways market, there's a negative market, there's benefit to be made from a falling market, or maybe rising interest rate on the fixed income side to hedge? Any plans in terms of how you guys are also promote alongside the distributors to the new category or the category of investors who are going to come in?
See, obviously, last, particularly from 2020 till 2024, was a phenomenal one-sided bull run we have seen. And last 1.5 years, sideways correction, consolidation, and again, we are coming closer to the lifetime high. So when you are in a falling market or volatile market, or I will say a range-bound market, then SIF type structures will generate extra alpha, because you can do through arbitrage also, and then you can actually generate alpha by shorting. Let's understand the traditional mutual fund schemes versus long account scheme versus balance advantage, or the DAF, what we call it. Okay, they also become very popular because they decided that this is for risk averse investors. Certain portion will be always hedged through arbitrage route, and they also got a very sizable, it had become a very large category now, which means there is a need for these products also. So it got evolved. We all thought of, all long accounts products are there, but BAF came into picture. We are also just launching equity saving. Again, we are launching only for risk averse point of view, okay, where we will not go more than 40%. So I think many schemes, many multiple, see, all depends on the individual stake also. All the SIF which people will manage by different money manager, they will bring their unique things which match their style of doing thing, their understanding or their experience or their philosophy. So I think that's the reason it is too mature to say that how whether it be something similar product is there. If you look at today also the tax plan, multiple people manage in a very different way. We manage tax plan in a different way as compared to industry. So I think it will evolve a lot. I think I look at a very positive way that one more interesting product which can actually diversify your risk, and it has certain needs of particular type of investors. So it's a unique opportunity to capitalize.
SEBI has defined a different branding for SIF. What is the branding for Quant? We haven't heard of it, so this can be a great forum to unleash.
Yeah, we thought we'll share when we launch our product, but it is 𝐸𝐴. Okay, so we call it 𝐸𝐴, and whenever we get opportunity to get the final approval on the ICIT side, we think we will launching that product. So it's a very nice 4-letter word, 𝐸𝐴. It's easy to recollect.
Which is Quant SIF.
Yeah, in some manner you can call it. Yeah, can call it. So, but since regulator was very clear that you have to differentiate your product. So obviously we can't use the first name. So we have called it as a 𝐸𝐴. I always like that 3-letter and 5-letter words. So it was fitting in that thesis also. So it is 𝐸𝐴. And luckily we got the approval also.
Thank you, Sandeep, for sharing your insights on SIF. I'm sure it will be valuable for our users. Before I let you go, I wanted to ask you the last question. What do you think about the 3 key benefits of SIF?
First important benefit is about the better risk management. Second is about the duration diversification, and third most important is the conviction. Conviction on both long as well as short side, so you can have a better focused portfolio.